Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden secrets of corporate America. And when I say hidden secrets, I mean a lot of zeros and dollar signs that can tell a wild story. Today, we're diving into Associated Banc-Corp's 2025 annual report, also known as a 10K filing. This massive document is like a company's autobiography, but with numbers. Before we get into the nitty-gritty, if you love getting the inside scoop on companies without the corporate jargon, make sure you are subscribed. We break down these filings so you don't have to. Also, if you want to chat with other finance enthusiasts and get more exclusive content, join our Discord community linked in the description below. Alright, Associated Banc-Corp, or ASB as you might see it on the stock market, has just dropped its 2025 annual report. So, what is the big picture? Are they rolling in dough, or are they facing some tough financial weather? Let's find out. This is a big one, a full annual report, so we're going to see the whole year's performance and what they're saying about the future. First off, let's acknowledge the elephant in the room. Their net income for 2025 was a cool $474,777,000. That is a huge jump from 2024's $123,145,000. To put it simply, they made way more money this year compared to last year. But it is not all sunshine and rainbows. Companies like ASB always have risks, and this report lays them all out. They're worried about things like credit risks, which basically means their customers might not pay back their loans. They also mention liquidity and interest rate risks. Think of liquidity as having enough cash on hand to pay your bills. And interest rate risk is how changes in interest rates can mess with their profits. They're really concerned about economic ups and downs, geopolitical issues, and what is happening in the stock market. This makes sense, especially for banks. When the economy is shaky, people and businesses tend to borrow less and struggle to repay loans. They also dive deep into how changes in US trade policies could hurt them, which is a big deal given the global economic climate. It looks like they're anticipating some stormy seas ahead, even with their recent profits. Now, they also talk about their allowance for credit losses. This is basically a big piggy bank they set aside for when loans go bad. They admit right here that this piggy bank might not be enough. That is a classic sign that they're seeing some warning signs in their loan books. Looking at their risk factors summary, it is clear they're juggling a lot. Credit risks, liquidity issues, rising interest rates impacting their mortgage business, and operational risks like cybersecurity threats are all on their radar. They specifically mention that the integration of core systems after acquisitions might increase cyber incident risks. So, if they buy another company, that could be a weak spot. And then there is government regulation. These guys are under a microscope. They're regulated by the Federal Reserve, the OCC, and the CFPB, which is like the financial cops. They're constantly worried about new rules and how they'll be examined. It seems like every move they make is watched closely. Speaking of risks, they dedicate a whole section to cybersecurity. They are clearly taking this seriously, mentioning their cyber defense center and having a pretty solid incident response plan. They use a bunch of fancy frameworks to protect themselves, but they also admit that the methods of cyber attacks are always changing and can be hard to predict, so they're doing their best, but breaches are always a possibility. Let's dive into the nitty-gritty of their financials. This is where the real story often is. Check out this table for 2025. Their net income was $474,777,000. Compare that to 2024's $123,145,000. That is a massive jump of over 380%. Their return on average equity also shot up from 2.86% in 2024 to 9.95% in 2025. That is a big improvement for shareholders. Their efficiency ratio is also looking much better. It dropped from 67.64% in 2024 to 56.29% in 2025. Basically, they're spending less money to make each dollar of revenue. That is a good sign. Now, let's talk about their bread and butter, net interest income. This is the money they make from lending versus what they pay out on deposits. For 2025, their net interest income was $1,201,145,000, a solid increase from $1,047,248,000 in 2024. Their net interest margin, which is like their profit margin on lending, also improved to 3.03% from 2.78%. They attribute this partly to selling off lower yielding investments and loans, which is a smart move when the economy is uncertain. And what about loan losses? The provision for credit losses was $54 million in 2025, down from $85 million in 2024. This suggests they're seeing fewer loans go bad, which is excellent news. But here is where it gets interesting. Their non-interest income went from a negative $9,407,000 in 2024 to a positive $286,400,000 in 2025. That is a huge swing. They explain this by saying 2024 had big losses from selling off parts of their mortgage business, and 2025 saw those losses mostly disappear. So, while it looks like a massive gain, it is partly a recovery from a bad year. They did see some growth in capital markets revenue, which is good, but that mortgage portfolio sale in 2024 really skewed the numbers. On the expense side, their total non-interest expense went up to $855,639,000 in 2025. Personnel costs are up, likely due to hiring and maybe better pay to attract talent. Technology and legal costs also saw increases. They explain this as investments in their strategy and consultant fees. And taxes. Their income tax expense jumped significantly to $103,133,000 in 2025 from just $11,314,000 in 2024. Their effective tax rate went from 8.41% to 17.85%. They attribute this to a strategic reallocation of investments and a plan to simplify their legal structure, which gave them a nice tax break in 2024 that didn't repeat in 2025. So, while net income is up, a good chunk of that improvement in 2024 was actually a tax reduction. Looking at their loans, their total loans are $31,163,614,000, which is up from 2024. Commercial loans make up a big chunk, 65% of their portfolio. They're also heavy into CRA, or commercial real estate, which they admit has more risk. The big worry here is that CRE lending might expose them to increased lending risks. They have $8.4 billion in CRE loans, which is 27% of their loan portfolio. That is a significant chunk to be exposed to an industry that has seen its ups and downs. Let's look at non-performing assets, which are basically loans that aren't being paid back. Thankfully, these are down. Total non-performing assets are $129,201,000 in 2025, down from $144,164,000 in 2024. That is a positive trend. Their allowance for credit losses on loans is also high compared to non-accrual loans, which is a good sign, meaning they have a solid cushion for bad loans. Their investment securities portfolio is also growing. Their AFS, or available for sale, investment securities are valued at $5,397,563,000, up from $4,581,434,000 in 2024. They've been actively investing, which could be good for future returns, but also means more exposure to market fluctuations. Now, about their funding, total deposits are up to $35,552,608,000. That is a good thing, as deposits are a stable source of funds. However, a big chunk of these $17 billion are actually uninsured. This is a concern in times of financial stress. Uninsured depositors are the first to pull their money out, which can create a liquidity crunch. They acknowledge this under liquidity and interest rate risks, stating that the proportion of uninsured deposits may expose the bank to enhanced liquidity risk in times of financial distress. This is similar to what we saw happen to other banks in 2023. On the strategy front, they're continuing with their growth plans, including the proposed acquisition of American National Corporation, valued at about $604 million. They expect this to close in the second quarter of 2026. This could bring more revenue and market share, but it also comes with integration risks and potential regulatory hurdles. So, what is the verdict on Associated Banc-Corp? They've clearly had a much better year financially in 2025 compared to 2024, with strong net income growth and improved efficiency. They're actively managing their risks, especially with the security sales and provisions for credit losses. However, there are still some significant risks they're facing. Their heavy exposure to commercial real estate and the large amount of uninsured deposits are definitely points to watch. The cybersecurity risks are ever present, and the evolving regulatory landscape means they'll likely face more compliance costs and scrutiny. Plus, the American National acquisition is a big bet that could pay off handsomely or create new headaches if it doesn't integrate smoothly. Overall, Associated Banc-Corp seems to be steering the ship in a more positive direction financially, but they're navigating some choppy waters with those risks. It really comes down to how well they can manage those challenges and if their growth strategy, including acquisitions, pays off. Alright, that is our breakdown of Associated Banc-Corp's latest filing. What is your take on these numbers and what they signal for the company's future? Let me know your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out. And make sure you subscribe for more corporate deep dives, and don't forget to check out our Discord community linked in the description to keep the conversation going. Thanks for watching Corporate Decoder, and we'll see you in the next video.